How's it going out there? It's November 3rd. And I'm Frank Curzio, host of the Wall Street Unplugged podcast, where I break down the headlines and try to tell you what's really moving these markets. Tuesday, Thursday, interview day, but I wanted to bring in Daniel Creech since we really wanted to break down the Fed, the reaction to the meeting. Positive, negative, positive, negative. Daniel, what's going on and what are your thoughts?
Hello, Frank. It's not very difficult to say what's moving the markets now. Hell, it's the Fed. End of podcast. That's a wrap. Let's go have a cocktail.
See you next week.
Yeah, we were off air. So, the announcement came out, 2 o'clock? Q&A starts at 2:30. And we're hollering here between the walls here at the office. We're both sitting in the offices and listening to Powell and things. And at different times, we're like, market's going to go up on that, and it'd pop a little bit. He's in it now. And what was your trigger? And I'll tell you my trigger on it. But I did think we disagreed with it about this, or it seemed to a little bit, because I was not surprised. I thought when I was reading the language coming out, I thought, hey, the markets are probably up, and they were. Are we disagreeing on that? I think the Fed is being a little wishy-washy and back and forth, and I think that's terrible. Let me tell you that I think it's ridiculous how they act. But I do think that they're trying to play both sides of the fence on purpose, and I think that that's just terrible, and that's why you see a lot of volatility.
You know what? The statement that came out appeared to be okay, but I think people took it where they thought that it was a bullish sign, and they're going to wait and kind of see and be more data dependent and stuff like that. It won't be, you're going to see the pace slow. Obviously, right? You're going to see the pace slow. I think it's hilarious that was actually... people look at it as being bullish. I mean, we raised 75 basis points 4 times. We've never done that twice under the Fed, the modern Fed era, right? When they started, focusing on the Fed funds rate. 2 times, we've never done it. 75. We've done 4 times. So, of course, they're going to slow down the pace. But I think people think that they were going to pause. And I didn't take it that it should have been bullish and the market was going up. And it's so funny because when you watch TV, I kind of feel bad. I feel bad for individual investors. I mean, based on watching TV, what hour you put it on, you're either going to put everything into the market or you're going to sell every single thing you own, right? I mean, if you look right after the meeting, the Dow started going on, went up 200-300 points, and everybody, with Steve Leisman on, was, Steve Leisman wasn't. He was like, I'm not seeing why this is bullish or why, just by the statement before, Powell started speaking. And everyone on there was bullish. Say, this is bullish. This is great. Now we have a target of how high. And I'm like, what are you talking about? And then, of course, Powell opened his mouth. And in the very first line out of his mouth, right off the bat, our top priority, very first thing he said, our top priority is getting inflation back below 2%. Right away, you should have shorted the market because in order to do that, we have to get rates above 6% now, not 5%. So I know they're saying 5%. I don't know what they're pricing in now. It goes back and forth. And but some of the things that he said he hasn't changed. I thought he was going to change 4 months ago, and then I was like, no, holy shit, these guys are serious. They're going to go crazy. They're going to keep raising and raising and raising. He's not stopping. And for those who think he's going to stop are absolutely crazy because, and I'll tell you why, because he's not concerned, he said, about the slowdown in housing. Someone asked, what about housing? And housing, we've seen a massive slowdown in housing, but he said, you know what? It was getting kind of overheated already, and credit is much better today than it was when we had the credit crisis. Meaning that I'm okay with housing coming down, so that's not going to stop me from raising rates. He also says, he actually said this, it's very, very, he used very premature to be thinking about pausing, which people were somehow hoping they would pause, even though there's no indication that inflation is really slowing with the indicators that they're looking at, especially if the manufacturing number came out, 2 days ago, 2 days ago, and then we had the jolts indicating that the job market is stronger than ever. He also said unemployment rate is at a 50-year low, and he doesn't see the case for real softening in the labor market just yet. And then he said he doesn't feel like they went too far yet in terms of where rates are right now. But for him to say he doesn't see the case for real softening in the labor market yet, and very premature to be thinking about everything is telling us that he's going to raise rates, and he's going to raise rates definitely by at least 50 basis points in December. The data is not going to get better by December. I mean, the data is going to be really ugly this month, and even into next year, I think they're going to have to bring rates to 6%. He made it clear that he wants real interest rates to be positive, meaning that he wants, if you're looking at the Fed funds rate, wants to be higher than the inflation rate, and we are pretty far apart from that, which means inflation needs to come down, which we're not seeing, or he's got to continue to raise. And we're only at 4%, Daniel. And you would think, all right, we're going to be at 5%. We're just at 4% right now. It's easily going to be 5%, I think, over the majority of next year. That's not priced in. It's not priced into earnings. This was the report that I pretty much expected, to be honest with you.
The only thing I somewhat disagree with you on is the language that they put out.
You were pissed.
It drives me nuts.
You were pissed.
It's just ridiculous.
When Daniel gets pissed, I like when people get pissed when you don't see him get pissed often because it makes it that much like entertaining.
I try to be a mellow guy, Frank.
So you're like, this is bullish, and then they started speaking. They're like, this is the opposite of what they're saying, and it kind of was, right?
It is. It drives me insane. I mean, you have the printout. They put language in there. When the Fed does this announcement at 2, they release everything. Like you said, they release it to everybody. Hey, here's what we did. And then the Q&A starts a little bit. So, financial media, us including, we're going through everything. But the language that they added, that, in my opinion, the reason the market popped 200 or 300 points on the Dow right away was because they added language in there about next rate increases will take into consideration the previous rate hikes and the momentum it's having, the effects it's having, et cetera. That was very new, and by itself, that is a bullish statement. And that was one of the reasons we started hollering back and forth between the walls. Mm-hmm. And then, to your point, to come out and say, it's very premature to think about we're slowing down or, rates have got to go higher for longer.
Right? He said they're not pausing. He's like,
and then to your point, to basically brush off the housing market and things of that nature.
He brushed off the housing market completely, which I was surprised at.
And again, if you want proof on why these guys have no idea what they're talking about and they're shooting from the hip, anytime, we've talked about this in the past, Frank, anytime somebody just lays it out there to say, oh, well, interest rates, they're not historically high. They're only back to the same rate they were in 2007, 2008, 2009. That's absolutely true. However, the purchasing power of the dollar that you're fed, you in charge, Jerome Powell, screw up constantly, devalue constantly on purpose, does not go near as far this time around. What?
You don't like the Fed, do you?
No, nobody should like the Fed. They're terrible. But my point is that to say interest rates are only 7% now, that's fine. But the payment is a much different. What about furnishing? What about the food and the furniture you put in your house, Frank? Is that the same price as it was in 2009?
Most economists
That's
don't
my point. Well, they
concept.
do. They either do and they choose to lie, or I just don't believe they're that dumb. I really don't. I mean, even sitting in school that long doesn't make you that dumb.
I mean, for you to be comparing this to when rates went from 8% to 20% and saying, hey, they were a lot higher, and we've seen old school guys get on and say, remember my mortgage was 20%. You were making 13-14% your savings account then too. So it was a different market then. When you go from 0 or 0.08%, that was where we were to where we are right now. I mean, at 3.25, we're up 4,300%. That's how fast. We've never seen anything like this. This is going to hit the market like a ton of bricks. We're seeing it in conference calls, which we're going to cover, as companies are admitting. You never see companies report record results. I've seen this quarter, report record results and sound the alarm and say, you know what, we're expecting okay. I mean, Mercer said the same thing, record results, but prices have clearly come down for shipping, and we're going to see this come down. We're expecting it to be pretty bad. And getting to Eaton, which, you covered, and that's in our portfolio, but you actually was listening to the conference call, and you actually said to me, you got to listen to this conference call, what these guys are saying. It just doesn't really make sense. I mean, the company's still intact. You're seeing record results, but, talk about that with Eaton, because it was surprising when you see a company report record results and then come out in that conference call and say kind of that's the top.
Yes. This is a great story to follow, because as we've talked about the economy, how interest rates and everything affect that and flow through the economy, GDP is down, we're in a recession, technically, blah, 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 blah. Then you read Eaton's, and these guys are a global intelligent power management company, and they have 3 main drivers or segments, and it's electrification, thinking electric vehicles, Mm-hmm. It's energy transition, so think of oil to cleaner, and then digitalization, just kind of like the Cisco that, mm-hmm. Remember when you, I like how you say, he said, in 10 years, 100 million products are going to be connected or whatever.
Yep.
And they talked about a recession a little bit. So back up one quarter. Last quarter is when it just sounded so off the wall from everything else you were hearing as far as the economy. They have record backlogs still to this day. It's growing like crazy. They're still seeing organic growth. The language was a little different and their tone was a little different in this previous call versus quarter 2, just because management says, hey, we expect a recession, but they don't think it's going to hurt they didn't lower guidance significantly or do anything like that. But they had adjusted earnings per share was an all-time record, and it's up 15% year over year. Mm-hmm. These are not easy comparables year over year to this company because they're essential. They never had, you could argue they have pull through from COVID, but they weren't, mitigated by it. Sales grew 8%. Organic growth was 15%, Frank.
Yeah. Yep.
All-time record segment margins of 21.2%. That's
important because
over 1%.
If you look at Eaton, really quickly, and explain that when it comes to organic, inorganic, you hear that. A lot of even Oracle, some companies do this. It's called roll-up strategy, and they'll continue to buy companies, and that's how they fund their growth. And if you're great at integrating like Oracle is, then you create a giant. But a lot of companies fail at this.
Right. And you have to watch leverage. They have about 2 to 1 leverage.
Interest rates, yeah. But these guys, right? So when they say organic, it's a big deal. It's a much bigger deal than inorganic growth. Is basically like you're buying the growth, right? So,
yep. All time. So the segment margins were over 21%. That was an all-time record. That's up over 1% or 1.3% year over year. That's significant. That doesn't sound like a lot, but when you're doing the volume in billions of dollars, that adds up a lot. The other thing they're saying, the interesting was when you look at their pulse on the economy, if you look through their transcript, they talk about a recession. They're not worried about that. They talked about EV cars and auto manufacturing chips and things like that. They expect the semiconductor issue and supply chains for autos to last through 2023. You've pointed out a lot how that's not the same language you hear from different auto dealers and things like that. To show you where margins can grow, Frank, what do you think? Well, that's a cheap question. I got to back up there. I'll just tell you because I don't know how to tease it very well.
Okay,
they do a lot of work with autos on the combustion engine side.
Yep.
They make 18 times more. Now, they don't break it down, but even if it's $1 over the course of running auto manufacturing and significantly doing that or being exposed to that, they make 18 times more revenue on an electric vehicle car than they do a combustion engine, they said. And they're looking to grow that big business segment, e-mobility, between $2 and $4 billion year over year.
Yeah, and that's a part in a car. Right?
Exactly.
So you're not looking at, how come, it's not like they're making the whole car. But
they're part. Yeah, I'm sorry. They're not manufacturing auto. I'm sorry. They're in the stuff. They do everything that sets up all the manufacturing.
Yep. So they make, absolutely. What I saw, and finish your point first.
No, I was just going to say, this is a dollar stock club pick, excuse me. I think it's about flat, maybe up 3%, but it went up. Well, it probably didn't finish up today with the market as everything else closed, but but it's doing well amidst all the market volatility. Mm-hmm. That was my last point.
If you look at margins, right, and quarterly earnings per share, you mentioned this. So here's a company that said they achieved record quarterly earnings per share margins. They saw significant strength across commercial, industrial, utility, and residential markets, basically almost all their markets. Total company margins also surprised a little bit higher, 21.2 compared to 21% estimate. And they said the supply chain inflationary environment is improving. The inflationary environment is improving. I haven't heard too many companies said that, right? So right there, you would think, wow, gangbuster quarter thing is going to go through the roof. But then they said, right? They said, and this is CEO coming out, that they expect a recession next year. Mm-hmm. Now, we follow these companies. We listen to what they say in conference calls. I want to say that is the first industrial company that actually said that they expect a recession next year. I haven't seen that. I haven't say, well, it looks like a soft landing, or we could. They're like, we're going to have a recession next year. If you're a CEO and you think you're going to have a recession next year, what are you going to do? You're cutting costs, right? And this is a company with record results. So if you're looking at earnings, what they're telling you is earnings just peaked. They're not going to get any higher. Doesn't mean the stock can't go higher because maybe they have a significant advantage over the competitors. They're doing much better, so they deserve a higher premium, a higher multiple. But this is a company that's getting it right across all the divisions, and they're saying that basically things have peaked. And this is a company that's getting it right. Think about the companies that are not getting it right. Now you're going to see earnings come down tremendously. They're going to come down tremendously just where interest rates. So the fact that they're going higher, you're destroying demand. You're destroying consumer demand, business demand. Any company that has a backlog, you have to cut that backlog by at least 25% because those orders are not going to get filled. That's the market that we're going to be in. Not everybody's going to be impacted. Most companies are going to be impacted. They're pockets of strength. Again, this is the first market that we've ever seen not ever seen, but it's seen in 12, 13 years where the Fed is not there to support us and not hand out free money. They cannot do that anymore. Okay, you can't even get it from politicians where we know it's going to be a huge day coming next week for the Republicans. You're seeing it. Even the Democratic polls, which usually, no matter what, we'll never tell you that Republicans are ahead, but you see this massive push into Republicans, which is going to be a split government. So you're not going to see a lot of spending coming out of government. You're not going to see, China. Where's the growth coming from China? Where, the real estate market, everything is horrible in China. COVID policy, who the hell knows what it is? But I know that a lot of stuff is still closed there. Where's the growth going to come from? And this is what's scary, because when the Fed's there to pick you up, like they were in 2008, 2009, when they're there to pick you up in 2020, when COVID hit, they're not going to be there to pick you up. Okay, so where is the demand coming from when we're not even talking? We're talking about rates, interest rates. We're not talking about the Fed massively shrinking its balance sheet, which they haven't really begun yet. And you're going to see that shrink by trillions. So, that means they're not going to be flooding the market with cash. That's a scary sign. So companies see this. They should see this. Eaton's a great company. They got a good management team. If you see this across the board, if you're a company, you have to be conservative here and you have to be cutting costs. You can't mess around. You could be wrong. You could always hire. But right now, if you look at the companies and what they're seeing, the projections right now are showing for 3 straight quarters of negative GDP going for right now, 3 straight quarters of negative GDP. Wait until that hits the news. People don't really know that. They're like, GDP 2% and over 2%. We did great. And, it's coming off 2 negative quarters. If that's correct, we're looking at what? 5 out of 6 quarters of negative GDP growth? I mean, with the Fed raising rates while this is happening? I mean, maybe not as the last quarter's coming in, but they're going to be raising rates for at least the next 3 to 6 months, as Powell said. So, it's interesting to see how a company like this is getting everything right. That's basically telling you, hey, our earnings peaked, and it doesn't get better than that. Think about the companies that are not doing great and how much worse it's going to get for them. And that's how you should look at the markets right now, which is great. But we want to cover a few more earnings. One of the companies that you...
Last thing on that real quick, because your point is their backlog is growing. So a couple things to watch here. I'm comfortable with the way the price action's holding up. The management team seems to be executing well. We'll continue to hold it in our portfolio. Yep. But to your point, we do need to pay attention over the next earnings about the backlog, margins, and also just like FedEx and everybody else can tell you, things can turn on a dime.
On a dime. And FedEx is smart because FedEx was like, all right, they pulled their guidance. They don't know what's going on. UPS was like, we're raising prices tremendously. And they beat the quarter and everyone's like, wow, UPS and FedEx are different. Well, okay, FedEx is going to be raising prices. But again, what does that mean? When you see companies raising prices, when you see their margins going higher, still going higher, it means inflation's not slowing. And inflation's not slowing. That means the Fed has a green light. They're going to continue to raise rates, which is going to be very crazy for the market. And that brings us to FirstCash. This is a company that you talked about that looks, really good for this market, right?
Yeah. Well, Powell is forcing everybody into pawn stores is my new theory, Frank. I think that's what he wants to do for Thanksgiving and Christmas. Just like Eaton's a good picture macro-wise of the markets and things like that, this is FirstCash is a pawn. I talked about this last week because they were having earnings. They hit earnings. I think the stock popped 8 to 10% afterwards. Solid earnings here. What I want to point out, Frank, is the Chief Executive Officer Rick Wessel says our third quarter results were outstanding with exceptionally strong pawn growth metrics in both the U.S. and Latin America, which drove increases in segment income. For the U.S., it was 35% higher, and Latin America was 14% higher year over year. Just like airlines, they have to compare to pre-pandemic levels to get an apples to apples. Pawn receivables, inventories, and resulting revenues are all well ahead of comparable pre-pandemic metrics at this point in 2019. He goes on to say that cash funding to customers, which is new pawns and direct purchases of merchandise for customers, in both the U.S. and Latin America, Frank, get ready for this, is one of my favorite words, remain exceptionally robust, with October above comparable pre-pandemic levels in 2019. So what happened? Why am I telling you this, Frank? And management is doing a good job of capital allocation. They authorized another $100 million in buyback. They pay a 33-cent quarterly dividend. That was 33 cents last quarter. Before that, it was 30 cents for a few quarters. So they bumped up that a little bit. So far this year, Frank, they have bought I just lost my place. On share repurchases. In the third quarter, they bought back over 600,000 shares for an average price of 75 and change.
And where is it, 90s?
From the year, they bought over 2.2 million shares at an average price of 71.63, and the stock is about 95 today. You don't want management team. Everybody can use share buybacks to help balance out earnings per share and all that results. You want to see management. Now, that doesn't mean they're going to buy back shares here. And depending on their growth, maybe they're buying back some. I'll pay attention to that next quarter earnings. The good thing to know about that is, as an investor, if you're buying this stock because you think there's momentum, because the overall economy is going to get worse, and that's better for FirstCash. So if you believe that there's going to be more headwinds, in my opinion, just what Powell told you the other day, then this is going to be on your radar and you can start nibbling away because you know there's another $100 million in authorization to buy back. If the stock does pull back along with the overall markets, at least you know a management team is capable and willing to step in and buy in large amounts of shares.
Now, this is interesting because what stood out to me is porn industry comprises of 80% of their pre-tax income. Do you know how much that they raised fees just in third quarter? 25%.
That's pricing power.
Think about that. But that's what a lot of companies are doing. I keep bringing up this example because I'm so pissed off that I paid $27 for 4 bagels at a local bagel store in Florida where bagels kind of suck here. This is a place that they're not so sucky. They're not like, holy cow, this is good. For 4 bagels. 2 egg and cheese, the other 2 with cream cheese. It's getting to a point where companies are just like, I just went to Vegas. The prices were insane. Everything is through the roof. People are raising prices. Every hotel on Expedia, everything, all of them charge $30 to $50 additional fees per day that you stay there. Right? Whatever. Resort fee, they're called, right? So now, and that's been happening for a while, but they're going up. They were like $20, $30. Now they're $50. Some of them was $75 when I was looking at hotels. What company has pricing power, and you have to look at what's going to happen in the future. So let's play this out. You're going to see demand fall off a cliff. You're going to see a lot of consumers who are used to having a lot of money not have a lot of money. They're starting to tap into their savings, which is at the lowest level in a very, very long time, in 15 years. It's at 3%, 3.3%. It's usually over 7% pre-pandemic on average. So where are they looking to tap this equity? I said HELOCs, and some guy was like, HELOCs, I work at a bank. And I answered, I said, this is what I'm seeing. There was second quarter numbers. We'll see the next numbers coming out because home prices have come down a little bit. HELOCs are a way for them to get equity out of their homes because that's their best asset, even though home prices are coming down. I like to see the latest results, but as of last quarter, which was only 2 months ago when they reported, you're seeing HELOCs explode for the first time since credit crisis. And now with porn, right? So, it's how are they going to get money? And this is one way that they do it. So where are the consumers going to get money to pay these much, much higher costs? Their costs are skyrocketing. And you could say, well, inflation is going to come down, but then you have rates. Most people are in debt. They're seeing their debt payments go up incredibly. And again, the Fed's not going to be there to hand checks to you like they did with the unemployment. Oh, take another 26 weeks. You're fine. You're good. Oh, don't worry about paying your student loans. Don't do that. That's gone. After next week, you're going to see a split government regardless. Regardless if you think it's not going to happen. If it's the House is almost a guarantee, but we'll see about the Senate. It's really leaning. I'd be surprised if it's not Republican. But you're not going to see anything pass on that end in terms of spending. So where is it going to come from? So you're going to have to take your medicine. This is a company that makes sense. They're right in the right industry. And not only are they in the right industry, I can't call it Arch Coal anymore, Daniel. I have to call it Arch Resources, right? Because you can't say the word coal.
We aim to be accurate here.
Oh, forget it. It's coal is like that one is on the danger list in the dictionary. Don't ever say coal. Forget it. They shut you down. Everything. But Arch Resources. Did you see those numbers?
I did. Yes, I did. You have them pulled up. I don't have the numbers pulled up. Do you have the number pulled up?
Yeah, I know you broke it all down, and you saw before me, and I said, I just really went through this, a little while before we got on air here. So, third quarter earning $8.68 a share, right? So revenues rose 45% year over year to $863 million for the quarter, right? That's sales. They made a dividend payment of $10 a share. $10 a share. What's the stock trading at? Do you have it up over there?
Well, that's a variable. It was around 150 last time I looked.
So you're looking at a company, and the market cap's around $2.7 billion, just to put it in perspective, right? So remember, no coal, they're bad, everything's horrible and terrible, right? But prices are going through the roof because people need energy. And they want to tell you they're buying coal. Even Germany is now buying coal. You see everybody buying coal, right? Because coal is very, very important, especially when everything's surging through the roof and nobody has anything else. And alternatives. You guys know the story. Anyway, thus far in 2022, they paid $25 a share in dividends. Starting in This quarter, they repurchased 2.3% of shares. So looking ahead in Q4, they indicated potential double the pace of buybacks. They generated $413 million of discretionary free cash flow. So free cash flow in the quarter. All right. So you're talking about a company, if you would times that by 4, right? You're looking at half of its market, 1.5, more than 1.5 billion in free cash flow for a company that has a market of 2.7 billion.
Yeah, it's crazy.
Has 442 million on its remaining on its $500 million share repurchase program. But what they said with all that cash flow that they're generating, which you see by these big dividends, is 50%, they said, of that free cash flow, they're going to return back to investors. And the other 50% is going to be used for buybacks and dividends, which, again, so special dividends in terms of free cash flow, but they're basically returning almost all their free cash flow back to investors in one way or another. Buybacks, dividends, special dividends, and the cash flow is enormous. I mean, it got to the point when we first talked about it that their cash flow was higher than its market cap. The only time you see that, that's a major disconnect, something you'll never, ever see ever. It just doesn't make sense. It makes sense because nobody even knows about this company. Barely anyone covers it anymore because they're not allowed to. But when shit hits the fan and you need energy, people will rather buy coal than die, right? Because I'll die today, but, climate change is going to destroy the world 3 years from now, according to the crazies out there. We believe in climate change. I believe in climate change, but not to the point where, the shit that's going on is insane. But Arch Coal is in that sweet spot that, Arch Resources is in that. I'm going to get canceled here. I'm throwing off of YouTube. But it's in that sweet spot where this is a company that works in this environment. Price is going to remain elevated. These guys are doing it right. I love that they're quiet about this, and they just keep paying shareholders. Isn't it nice? Who cares if anyone knows? But nobody knows about this company. Reminds me of Texas Pacific Land Trust, which is at all-time high. I mean, I sold 15 shares of that for my mom the other day. It's at 2,000. She's her cost base in single digits. My dad owned it for 25 years ago. It reminds me of these companies that nobody ever heard of because they don't really need cash. Nobody really covers them. They're not mentioned anymore. And yet, I don't think you're going to find a company with better fundamentals than this in this market. If you can, feel free to email me.
It's just wild. I would love to have a adult beverage with the management team of this, because when I read through these press releases and conference calls, I'll be honest, I'm impressed. I mean that sincerely, because they're just very straightforward on it. And what I want to try to explain on why people ought to pay attention to this, and whether or not if you bought the stock and followed our advice or listened to our thesis on it, the big takeaway here is supply and demand and politics. And just like what I talked about yesterday on yesterday's podcast, when we were talking about the letters that certain Congress and senators are sending to the Fed about warning on inflation or raising rates and things like that. During the conference call of Arch Resources, an analyst asked a good question about, hey, you've talked about, a couple years ago when you were setting your targets, you have these coal power plants and coal mines retiring out of production. And to Arch's point, they put a lot of money aside to funds because their industry is shrinking and going away. Nobody is arguing that. And the CEO, Paul Lang, put it this way and said, listen, I'm pragmatic from a point of view. He says, listen to this, Frank. And this is why when you have policies directly affecting prices. So nobody likes, as your point, you can't even say Arch Coal anymore. Everybody gets all upset about it. Mm-hmm. Yet they are printing money. The CEO said it this simply. Last coal-fired plant was built about 10 years ago in the United States, and the average age is creeping up to 47 or 48 years. He says the trend is continuing. We'll see slowdown in retirement. Some of them may have to get extended because of global demand. He says, and they're still dealing with rail issues. They can't get enough rail cars to carry out their coal. So they're still dealing with that and all kinds of things. It's not like everything's perfect, but they're executing well in a tough environment. They're talking about their Black Thunder operations is in this area. But the CEO says, and we could have some industry, we could see some slowdown on the thermal side. He says, but it's going to be a very profitable period of time where this call is going to be headed, and we'll do very well. He says, I'll tell you what we're not going to do, and is invest anything to increase production. That is because you have policies telling you they're going to penalize you. From coal to oil, it's about the rumors of windfall taxes and you're painting people in a public eye. You're using it's just politics to paint people against each other because you're using it's basically class warfare. Hey, you're having a problem, you're paying higher energy prices, it's because of these guys. These guys are bad. These corporations are bad. It wasn't too long ago when we talked about when the bank's CEOs were drug up in front of Capitol Hill, and one representative questioning Jamie Dimon said, well, everybody at your bank should take their money elsewhere anyway. These have massive implications as they unfold over time, and it affects markets in a massive way. You can ignore it. You can email me, Daniel at CurzioResearch.com, to tell me to quit talking about politics. But politics are why we found this company and why we are doing so well for subscribers. And that's why you ought to pay attention to it. You can disagree, but disagree and make money.
And you have to look at it from just like what the Fed is saying right now, that in the housing market, right? So if you're in the housing industry right now, you better be making adjustments, because the Fed just came out and told you that I don't care that it's kind of frozen right now. Maybe in some states it's still okay and prices are coming down almost everywhere, even in Florida they are, and in Texas, not by the extent they're coming down every place else. He goes, I don't really care. He goes, it was inflated. There was kind of a bubble there, and most people have a lot of equity in their homes still, so you're good there. So basically, they told you that doesn't matter, right? So if you are a CEO in the housing sector, you are looking at that saying, holy shit, things are going to get a lot worse. When Biden won the election, he said, all right, we're going to cancel Keystone Pipeline. We're going to get rid of fossil fuels. That's what he said a year or two before he was, as he was campaigning, regardless of what you say. We want to reduce fracking and get rid of fracking. All right, regardless if you believe that or not, if you're a CEO of a company and you're listening to that, you have to prepare. Because if that's the case, you're going to see a significant slowdown. It's just funny how the intention is, a cleaner environment. This is great for everyone. And I wonder if the oil companies are all just sitting there going, man, we want to get Biden elected so bad right now because we're just going to be reporting windfall profits forever. It's going to be the greatest thing ever. I don't know if they were thinking that at the time. And now that they're making these massive profits, all because of this administration, where they come out and they're like, oh, we want to tax you on all these profits. It's just, which is remarkable to me. I mean, the irony is incredible. But you do have to pay attention to politics, guys. I don't care what side you're on. This is about your money. That's all you should care about. I don't care about your politician. They don't give a shit about you. You should know that by now, right? I mean, you should. Hopefully you do. I don't care what side you're on. Care about your money. Listen to what they say. You could disagree, agree, whatever side you're on. But the bottom line is you want to make yourself financially secure for you, your kids, for the rest of your life, and maybe create generational wealth, which I think you'll have the opportunity to do if you start to learn how to buy long-dated puts. I've been pounding this since November. We're seeing a lot of people take us up on this offer, which is a $5,000 product, Money Flow Trader. Again, we discounted for 3 months for $4.99, so it's like a 90% discount altogether. We've got a lot of people take us up on it. This is the type of market of what you just saw. This is what you're going to be used to seeing. Okay, you get this rally, you're like, holy shit, and then you see this downfall, like this massive pullback in one day of 3%. And if you're buying long-dated puts, you're not worried about what the market does in a week or a month or 2 months. You're worrying about, the first 6 months. Do you think you're going to see this crazy volatility? Do you think it's based on the put and buy, what price you're paying, which is why Jenny Turner is the best in the world at it, and she'll take care of all that. It's a very easy strategy. You should be buying long-dated puts. It's betting against stocks. It's betting against markets that they're going to come down further. And if they don't, then you're going to be long your positions and you're going to do fine. It's not a way to hedge. It's a way to make 500, 1,000% gains if you get a stock like Meta that's down 70% and keeps going lower and lower and it hasn't found a bottom yet. And you're seeing Google, you're seeing some of the best names in the world are getting annihilated. Not all of them. We've seen a lot of these come back. And that's why I said right now is one of the greatest times because we had the best month, right? Just, again, it's seasonal. Money's coming into this market. It's being artificially inflated, money pouring into, again, just because of seasonality. And you see we have the best month since 1974. Now you got an opportunity to really see what happens because demand's going to fall off a cliff. The Fed is telling you exactly what they're going to do. They haven't changed their tone. I thought they were full of shit 5 months ago. They're not full of shit. They're serious. Rates are going a lot higher. They're going to be more than 5%. I don't think that's priced in. And the earnings decline. Where they have earnings right now, they were 244 when I've been reporting to you for the last 2-3 weeks. Now it's down to about 230, 234, I think. So for next year, I think that number is going to be under 200. If I'm right, we still have significant downside in this market. You're going to see ups and downs. This is a way to make an absolute killing in the market. So if you're interested in that offer, again, you go to our website, take advantage of it. If not, learn the system. It's not going to be as easy unless you're following someone that makes it easy for you because all you got to do is do what they tell you what to do. You don't have to worry about things like implied volatility and the pricing and when to sell. Jenny lets you know all this. She's one of the best in the business. Amazing performance this year. This is what you need to do to protect yourself. Okay, it's not in our best interest to tell you that the market's going to come down, right? Most people are long. It's contrary to my business needs, but this is a product. This is the reason why I created. I got my ass kicked on it for a couple of years because the market's going to crash 2019 and pull back. And then we saw COVID eject $11.5 trillion of money into the market. So it went up a little bit, but now this is it's like shooting fish in a barrel. I said that this is what you have to learn. Trust me on this one. Again, if not, you can go on Google, look at my address. I'll answer the door. You can punch me in the face if you think I'm wrong. But trust me, you are going to thank me. And I don't even want you to thank me because this is a great, great strategy in this type of market. And you're going to see markets like this where they go up and up and up, and then you get a big crash like that. Let's see. I don't know where it's going to be the rest of the week. I know it's going to be next, but I know over the next 3 to 6 months, it's going to be hell. The Fed is raising rates. They have to force a recession. There's no easy landing here. There's no easy landing and inflation is going to come down. Inflation is either going to surge or you're going to crash the market. Okay, so that's where the Fed's at. They know it. A lot of people don't know it. But it's not a pretty outcome either way. Let's see what happens. Dan, you want to finish with anything? Any parting thoughts? Got a lot of earnings. Holy cow, a lot of earnings going to be reported in the next couple of days. It's a lot of small caps to mid caps. So
yeah, a handful that I'm reading through and still going over. No, I thought you said it well. I would definitely follow Money Flow Trader. I just think the Fed is giving you a roadmap of more pain ahead. Just pay attention. And as what you said earlier, when comments are made from public figures, CEOs have to make adjustments. Mm-hmm. Look at yourself as a CEO of your own money and be prepared to make adjustments because of what the Fed and what we talked about today. Absolutely.
Yeah, remember, this isn't shorting the market. If the market goes the wrong way in a month, this isn't shorting the market where you can get annihilated because, I thought the market was going to come down in October and I was dead wrong. I also said if it doesn't come down in October, it's definitely going to come down over probably the next few weeks, if not very early in 2023, because the Fed's not stopping the raise rates. They're just going to keep raising rates. So, this is a strategy that works. You only lose the amount of money that you put into each option trade. And it's very easy to do in your portfolio. So this is something, learn it, guys, learn it. You don't have to pay for the product. I don't care if you buy it, if not, whatever. If you do, it's I think.
Well, we kind of care. Go ahead and buy it.
No, I mean, listen, we're a business. Yeah, we want you to buy it. And this is not a sales pitch, but this is, you guys know me where, look, if I'm wrong, you're not going to subscribe to anything ever. So my job is I don't get paid by anyone. We don't get paid by outside party. My job is I have to show you returns. If I don't, you guys don't subscribe to our products. But I've been doing this for 30 years, meaning that I've been right more than I'm wrong. And this one, unfortunately, I think I'm going to be really right on because, and I say unfortunately, because I think it's going to hurt a lot of people where this market's going. And you're really going to see it over the next 3 to 6 months, really over the next 3 months. So again, hopefully I'm wrong on that, but this is a good way to make a lot of money and be put in a perfect position to have a lot of money when these assets do come down, when you can buy them at dirt cheap prices. So Daniel, thank you so much for coming on Interview Thursday.
That's right.
2 days in a row.
Have a great weekend, everybody. Cheers.
Yeah, have a great weekend. And again, that's it for us. Questions, comments, FrankCurzioResearch.com. Daniel, email?
Daniel at CurzioResearch.com.
Okay, guys. Really appreciate all the support. I'll see you guys next week. Take care.